Investors are always looking for ways to make their money grow. Some investments promise high yields. YieldMax ETFs are one such investment. These ETFs aim to provide much higher payouts than regular stocks or ETFs. This sounds very tempting, especially when interest rates are low, but investors must be careful. High yields often come with high risks. YieldMax ETFs use complex strategies to achieve these high yields. These strategies involve options, which are contracts that give investors the right to buy or sell an asset at a certain price. Options can be risky, and not all investors understand them fully. This lack of understanding can lead to unexpected losses. One of the main strategies YieldMax ETFs use is the covered call strategy. This strategy involves selling call options on stocks or other assets the ETF owns. Selling these call options generates income for the ETF, which it then distributes to investors as dividends. While this strategy can generate high income in the short term, it has a downside. When an ETF sells a call option, it limits its potential gains. If the price of the underlying asset rises significantly, the ETF won't benefit fully because it has already agreed to sell the asset at a lower price. This limitation can hurt the ETF's performance over the long term. Another problem with YieldMax ETFs is the potential for NAV erosion. NAV stands for net asset value, which is the total value of an ETF's assets minus its liabilities, divided by the number of shares outstanding. Think of NAV as the intrinsic value of each share of the ETF. When an ETF consistently pays out more in dividends than it earns from its investments, it has to dip into its principal. This eating into principal leads to a decline in NAV. Over time, NAV erosion can significantly diminish the value of your investment, even if you're receiving high dividends. In addition to the risks mentioned above, YieldMax ETFs also charge high fees. These fees are often higher than those charged by traditional ETFs. These high fees eat into your returns, leaving you with less money in your pocket. Investors should always pay attention to fees. High fees can make a big difference in your long-term returns. It's essential to choose investments with reasonable fees to keep more of your hard-earned money. Remember, the goal is to grow your wealth, not to see it eaten away by fees.